Good afternoon, everyone, and welcome to Giving Smarter Tax-Efficient Strategies for Charitable Impact. Glad you could join us today. Give it just a couple more minutes, for a minute or two. We've got a number of people that have registered for the webinar. Want to make sure they've got some time to jump in. So if you can just hold on for maybe another minute, let some other folks jump in, and then we'll get started. Welcome to our year-end Giving Smarter Tax-Efficient Strategies for Charitable Giving. My name is Thomas Sunnick. I'm the founder of TM Wealth Management. Glad you could join us today for something that's kind of really important, and some real significant changes are coming about with charitable giving. So that's why we thought it would be helpful to have this webinar this afternoon. Keep it pretty tight to 20 to 30 minutes, give you a lot of content. Feel free to ask questions. We won't have time because we want to be respectful of people's lunch hour. We won't have time to review the questions, but we will respond to all the questions. So when you do submit those, we'll send out an email or a follow-up to give everybody's questions answered. One of the key things as we get started here, just want to make sure we've got the appropriate disclosures. This is purely educational. We're not tax professionals. We are not attorneys providing any legal advice, but we do want you to reach out to your professionals and share the general information that we're sharing with you today with them so you can have better advice. Also, at the end, you have an opportunity to schedule some time with us. Happy to work through with you the specifics of how these topics apply to you and your unique situation. Again, just a little bit about me in terms of my background. Undergraduate degree in economics, MBA from Columbia Business School, and started my career on Wall Street, but ultimately found wealth management to be much more fulfilling, to sit across the table from families and individuals and help them make good financial decisions so they can impact the people and causes they care about most. And that's what we want to talk about today is kind of how to impact those people and causes with your charitable giving. And quickly, just a little commercial about TM Wealth Management. Everything you need to know about us is in our logo. We do wealth management, which means we focus on everything that impacts your financial life, not just stocks and bonds or your portfolio. Estate planning, tax planning, financial planning, money management, insurance, all things that impact your financial life we pay attention to. Additionally, we're independent. I worked for large investment banks, and that was great. But they've got a different profit margin or profit, things that are driving them to generate profits than solely focusing on clients. And so that's why we structured TM Wealth Management to be independent. Also boutique. Again, working at large investment banks, it's very challenging to keep track and add value consistently to thousands of client relationships. So we wanted to keep things relatively small so that we could spend more time with our clients. And lastly, a registered investment advisor. We are fiduciaries. That's the structure that we chose to operate under. So we have a legal obligation to do what's in our clients' best interest. So that's a little commercial. As we think about charitable giving, I think it's important as a planner and as families to think about how to engage the family, whoever that might be. Maybe it's just your spouse. Maybe it's kids. Maybe it's grandkids, cousins, whatever the family dynamic is for you. I think engaging them in the giving process helps you have a greater impact with your resources, with your money, so they can see the impact that your money is having on other people and other causes. So just a couple of quick steps to think about engaging the family. Develop a family giving statement, right? What are you trying to impact with your giving? And as you can structure that giving statement, It's something that you can refer back to as different family members, different charities come to you looking for donations. You can say, well, does this fit with our overall family giving statement? And then collectives of family decide where and when to give, right? Where specifically, what types of charities, and throughout the year, when do you want to give, right? Do you want to impact the holidays, or do you want to give in other times of the year where it might be more welcome, more recognized, because it's not given at the time when everybody else is giving? Lastly, select a giving vehicle, right? Think about how you want to give. Are you going to give stock? Are you going to use a donor advised fund? Are you going to structure a family trust and different vehicles to utilize that giving, not only for tax efficiency, but also for legacy planning, right? If you're going to have these giving goals go beyond your life and on down the next generation, that's a different vehicle than maybe just cash, stocks, or a donor advised fund. And then last, I think the most important one is assess your impact, right? Go and visit the charities or the causes and get involved there to see what impact your financial resources are having on those causes, on those endeavors, so that you can, when you come back to your family giving statement, hey, did that gift, that donation to that charity or that cause really have the impact that we were wanting to have, and make it real, right? If you can get to know the families or organizations that are benefiting from your donations, I think that it can really be more impactful for the family as you look to do more giving to that specific charity. So as always, as a financial planner, start with a game plan. Start with a plan about what impact you want to have. So develop a family giving statement, decide where and when to give, select a giving vehicle, and assess your impact. And then we want to highlight that there's some changing landscape, tax landscape to giving. And we'll get into the specifics here. But because of the One Big Beautiful Bill Act, in 2026, the deductibility of charitable contributions has some changes. So first, one of the big changes is in 2026, there's a 35% tax cap on itemized deduction tax benefits, right? So if you're in the top tax bracket right now, you're in the 37% tax bracket. For charitable and itemized deductions in 2026, that doesn't matter. You're going to be in the 35% tax bracket in terms of what you can actually deduct from on itemized deductions. So even though you might be in 37% tax bracket, giving and the deductions you're able to take are going to be limited to the 35% tax bracket. Secondly, another big change is that in 2026, there's going to be a 5% adjusted gross income floor on charitable deductions. What that means is the first 0.5% of your AGI, you do not get to deduct. So for example, in this little example here, where it talks about an individual with $1 million of AGI, that means there's a $5,000 floor. So the first $5,000 of charitable deductions, they're not able to give in 2026. So it might make some sense if you plan on doing some giving. Hey, maybe I front load or back load, however you look at it, 2025, put more charitable deductions or more charitable donations in 2025 to avoid that floor in 2026. But it's going to be an ongoing floor, so it's not, it just begins in 2026, so something to be aware of. And here's a little bit of an example of how this floor is going to operate. So let's consider a married couple with $2,000 of AGI who typically donates about $1,000 a year. In 2025, since there's no floor, they could deduct the full $1,000 of their charitable gift. Well, in 2026, with a $200,000 AGI, they're now going to have a $1,000 non-deductible floor. And so their now $1,000 annual gift is going to get 0 tax benefits. And so one of the flip sides to that is if you don't itemize, as you can see up here in, let me get a highlighter and highlight a couple of these things. As you can see up here, non-itemizers will receive a universal deduction of $2,000 for cash gifts. So for this $2,000 AGI couple, if they decide not to itemize, then they can take the standard deduction and get an additional $1,000 because that's what they donated. Now, if they donated $2,000, get up to $2,000 of a deduction for cash gifts. So that's kind of the flip side. Additionally, for larger high net worth individuals, you can see if you're in the 37% tax bracket, you have $1,000 AGI, and you make a $100,000 charitable cash donation in 2026. Well, in 2025, if you had done that, you would have gotten the full 37% tax deduction, $37,000, because that's a tax bracket you would be in for 2025. Now in 2026, because of that 0.5% AGI floor, now the first 5,000 is not deductible, so now you only get to deduct 95,000. And in addition, you can only get a tax benefit of a tax top rate of 35% for itemized deductions. Now what that means is that 100,000 deduction now is $3,750 less than what it would have been in 2025. So as you start to think about what donations or what charitable giving you want to do, just be aware that things will change in 2025. Great. So we want to give you kind of a framework or some steps of thinking about how to be more tax efficient with your giving strategy. So we've got 4 things we want to highlight today. Make use of QCDs, donate appreciated stock, bunch your donation years, and make use of donor advised funds. And so let's go first to make use of QCDs. So these are for people that are already taking their RMDs. So you're either over 70 and a half or over 73, depending on when you were born and which rules you're under, because they recently changed the age at which RMDs start. Currently it's 73. It will ultimately go to 75. But this is Chris and Dana. They're both 75, currently taking their RMDs. They have Social Security benefits of $20,000. And what it allows you to do, what a qualified charitable distribution allows you to do, is take your RMD and instead of you receiving it, you send it directly to the charity or charities. And then that money just doesn't even show up on your tax returns. Like it never happened, but it also satisfies the required minimum distribution for that year. So let's look at Chris and Dana if they do a deductible donation. So they have $20,000 in Social Security benefits, $20,000 in pensions. They take their required minimum distribution as $40,650. So that gives them an adjusted gross income of $80,000. They're now over the threshold where Social Security becomes taxable at 85%. So $17,000 of their Social Security benefits are taxable. They have a pension. They've got the RMD of their income. So their adjusted gross income is now $77,650. They now make a donation of $40,262,000. So they make that charitable donation. So now their taxable income, and they itemize, right? So their taxable income comes down to $37,000. So the income tax that they would owe at the end of the year would be $4,000. So difference is if they decided to, instead of doing a deductible donation, they just did a qualified charitable donation, everything stays the same except their RMD, instead of showing up in their income, now just disappears, right? They get a negative charitable qualified distribution, right? So they look at their taxable income. One, that creates their adjusted gross income of $40,000, which now is below the threshold where their Social Security income becomes taxed. So you see now they pay 0% of their Social Security income is taxed. So the 0 taxes there. Still have the same pension, still have the same RMD, but they send that RMD directly to the charity. So now their adjusted gross income is only $20,000 and their tax now is $2,000. So a savings of a little over $2,000 just by doing a qualified charitable distribution. Now, as you can see, you don't do a QCD just because of the tax benefits. If you need that income, then you need to receive it, pay the tax on it, and utilize it for your living expenses. But if you are charitably inclined, a QCD can be very tax efficient because it not only doesn't show up on your income statement, your tax return, but it also reduces your overall adjusted gross income. That can reduce the taxes or kick in some other tax benefits that you might not otherwise have been eligible for given a higher AGI. So QCDs, and we do this for clients throughout the year. We've got a number of clients that send a spreadsheet and we send out $1,000 checks here and there to these different charities that they want to impact. Great. Next, so donate appreciated stock. This is a great one. Something to be very aware of is instead of giving the charity cash or writing them a check, and given where the markets have been the last couple of years, most of us have appreciated positions, and specifically positions that are long-term capital gains. We've held them for more than 12 months. So rather than giving the charity a check for $100,000, what if we gifted them $100,000 of appreciated stock? So here in this example, right, the cost basis in the appreciated stock is $20,000. So if they sell the asset, so if they take $100,000, they're going to pay federal capital gains at 20% on the $80,000 of gain. They get a charitable tax deduction. Basically, this is what they've gifted times their 37% tax bracket. So what the charity ultimately receives is $84,000, right? Essentially 16,000 minus the 100,000 gives us $84,000. And they only get to deduct the gift, right? So $84,000 is what they get to deduct because that's what the charity received, because there was a tax implication. If they donate $100,000 directly to the charity, right, there's no capital gains because you didn't sell the stock. Now, if the charity sells the stock, that's on them, but they probably don't pay capital gains tax, so that's great. You get the full deduction at the 37% tax rate on $100,000. That's $37,000. The charity gets the full $100,000 donation, right? So it increases the charity's donation, what they receive, by $16,000. You save $5,200, almost $5,300 in additional tax savings because you avoided this $16,000 tax bill on capital gains. One of the things that we advise clients to do, though, is the $100,000. If you have the cash that you were going to donate, give them $100,000 in cash, take that $100,000 once you've donated the stock and go back and buy the securities back, right? So let's say you had Apple stock, you donated to the charity, you had a basis of $20, and now it's trading at $200, so $180 of capital gains. By donating the stock, you avoid that capital gains. But then if you go back in, take that cash and put it into your investment account, buy Apple stock at $200, you have kept the same allocation within your portfolio, but now the capital gains associated with that Apple stock that you bought at $20 is gone. So you're able to maintain that asset allocation or the structure of your portfolio by taking that cash and reinvesting it and buying the exact same security. So donating appreciated stock is a great way to do some charitable giving from a tax efficiency. Just need to work with the charity to make sure that they are set up to receive donations in kind, is the IRS phrasing in terms of donating things that have appreciated or assets. The next thing to look at is bunching your donation years. Because the standard deduction has gotten so high at this point, people that do something around 10,000 or less, depending on their other expenses, may not be getting the charitable deduction. And so if you can bunch your charitable donations in off years, then you can get a larger tax benefit from your charitable giving. So for example, here's an example for the Palmer family. They pay $4,000 in mortgage interest, which is, if you itemize, tax deductible. They pay $10,000 in state and local taxes, which is referred to as the SALT tax. By doubling their usual $10,000 donation in years 25 and 27, they exceed the $30,000 standard deduction. So they're getting a bigger tax deduction by doing this bunching than just doing it in off years. So what you can see here is in the off years, right, if they did their standard giving, if we look at 2026, right, they have $10,000 of SALT deduction, they have $4,000 of item or interest on their mortgage, and let's say they put their $10,000 on top of here, right? So that would be $24,000. They wouldn't be getting any charitable deduction because the $30,000 standard deduction is more than the 24 that they would get. So by bunching, right, we say, okay, well, let's do 20,000. So do 2 years of charitable giving, your 2025 and 2026. You're able to now, it exceeds the standard deduction. And now you're getting a tax benefit, a tax deduction for the charitable contributions that you're doing. Then in the off years, in 2026, you take the standard deduction of $30,000. And so you can bunch these. Now, The standard deduction is indexed for inflation, so it will continue to go up. So this is something you need to evaluate. The other thing that's coming in terms of the change in the tax code from the one big beautiful bill is the SALT deduction now can go up to 40,000 depending on your income. I think the limit now is $500,000. So if your AGI is below $500,000, this SALT deduction now becomes $40,000 or whatever the state and local taxes you've paid. So, but it caps out at $40,000. So just something to be aware of, and plan your charitable contribution so you can take advantage of getting some tax deductions if you do this bunching, right? Think about, let me do 2 years of contributions of donations in 1 year, take the standard deduction in an off year, right? And this takes some coordination and some planning, but it's a way to maximize the tax efficiency of your giving. Great. Lastly, make use of donor advised funds, and these can be used at any time, but it is even more beneficial in a year when you're expecting a high income year. Maybe you're getting a large bonus. Maybe you sold, your business or an investment property or something where you're expecting a large, unusually high income year. And so if we look at this, this is somebody that's going to have be in the 37% tax bracket in a specific year, right? And they're doing about $100,000 of giving each year. Well, if they accelerate that and said, okay, well, let me do $1 million donation into a donor advised fund, and we'll talk in just a minute about what that is. If they do $1 million donation into a donor advised fund, then they get the full tax deduction of $1 million, again, subject to certain caps that are coming, but they get the full deduction in the year that they make the donation to the donor advised fund. Then the way the donor advised fund is, then you can distribute that money over whatever period of time you want. Now, you don't get an additional deduction for that, but it allows you to take a huge deduction in the year in which you take it or make that donation. And so in this specific case, right, rather than doing $100,000 over 10 years with these consistent tax rates, except for the 1 year, that's a tax savings of $253,000. If you do a one-time donor advised fund, because in that year you're in such a high tax bracket, you get the full $370,000 tax deduction, which is a 46% savings over if you just did $100,000 each year over the next 10 years. So that's utilizing a donor advised fund specifically in a high income year, but it doesn't have to be. So the way a donor advised fund works is you're effectively taking your cash or appreciated securities or other assets the donor advised fund will receive. You gift that to the donor advised fund. The donor advised fund then invests those proceeds, and you can decide at what level you want to invest. You can be aggressive, very conservative, somewhere in the middle, kind of moderate. And then as the charitable assets in the donor advised fund appreciate, that just allows you to give out more. Now, you don't get any additional deduction if the donor advised fund assets increase, but it just means there's more money there for you to give. If it goes down, you also don't get any reduction in your charitable donation, but you also don't get more funds to gift. So then you can distribute money out of that donor advised fund to whatever causes you care about, education, housing, helping people with employment, whatever you want to distribute to recognized charitable entities. You can distribute that over whatever time period you want, and those funds are invested to appreciate. So a donor advised fund is great for, hey, we're not sure who we want to give to, but we want to get the deduction in this year. So maybe make a contribution to a donor advised fund. The funds get invested, and then you can decide to distribute them whenever you want. That same year, years into the future, maybe that's part of the family effort to get together and think about, hey, we want to give some of the donor advised fund. Who should we give it to? It's a great way to get the tax deduction up front and then distribute to the charities over whatever time frame you want. So donor advised fund is a great option to get that accelerated deduction. So let me just summarize, right? So make use of QCDs, donate appreciated stock, bunch in your donation years, and make use of donor advised fund. These are some great ways, especially in this year where we're starting to have some significant changes to what might be deductible in 2026. Making use of these on a consistent basis will help you get more bang for your buck and potentially getting more of the contribution going to the charity. So that's great. It's all helpful, but what can you do with this knowledge? One, we have a number of resources, if you like, estate planning resources, charitable giving resources. At the end of the webinar here in just a minute, you'll get a survey. You can put in there, please send me these guides, or let me schedule an initial consultation. And also, we're happy to offer this or do an initial consultation. You can scan that QR code that's on your screen, look at our calendars, get something on our calendar. This is nothing more than a 15 or 30-minute conversation to talk about some specific questions, concerns that you might have, and how we can help you apply these specific principles to your unique situation. There's no sales. It really is about how can we help. If there is an opportunity for us to have an ongoing conversation and develop a business relationship, that's great. But the goal with these initial consultations is really to learn a little bit more about what your needs are and give you some specific advice about how to implement these principles and these strategies into your unique situation. We hope you'll take us up on it. Most people find great value in just talking to us for 15 or 30 minutes. So I encourage you to take advantage of that. And with that, we thank you for spending a little bit of time with us. Hopefully, you got a couple of tidbits that will be helpful to you to make better financial decisions and also to help you get more tax efficient with your charitable giving. Thanks for your time and thanks for joining us. And hopefully, we'll see you on our next webinar.